So let me ask you this question. How has following the money personally impacted your investment decisions and your successes? I know you were in the medical devices sales before, so let's talk about that a little bit.
Yeah. So, man, where do I start? They say that a high tide lifts all boats, right? And so there's some really great wisdom that I cannot take credit for. Warren Buffett has this quote that talks about when the tide goes out, you can see who's swimming naked. And,
Mhm.
for me, I got kind of lucky, right?
Mhm.
I didn't know all this beforehand. I was in the Nashville, Tennessee market for 10 years ago. I moved here 10 years ago. It was for healthcare, for medical device sales at the time. And I wasn't in real estate. I didn't have this passion to go and be an entrepreneur. I was actually fired from my job one lucky Friday. And that's how I started my entrepreneur journey. And so I was blessed to be in one of these markets. Like I said, Nashville, Tennessee, it's been one of the top 10 fastest growing cities. There's been tons of businesses that are moving here. There's over $7 billion of institutional capital that has planted its roots here, and that's continuing to grow. And so I was kind of right place, right time when I stopped my whole corporate career and began this entrepreneur journey. And so that played into my success.
This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As an investor and a fund manager, I'm always excited to explore the wonderful world of real estate, the real estate opportunities with you and for you. Today, I have Brandon Cobb with me. Welcome, Brandon, to the Real Estate Vibe Show.
Vinki, it is a pleasure to be here. Thanks for having me on. It's also great to see you.
I'm so delighted for our conversation today, Brandon. A little bit about Brandon. Brandon is a former medical device sales rep. He turned into a fund manager in Nashville, overseeing 22 million plus annually in first-time home buyer housing and built-to-rent communities. Featured in REI, Wealth, and Forbes, his passion lies in creating memorable experience through his business ventures. Today, we have a very exciting episode, actually. The topic is really good. The topic is given to me by Brandon, of course, and topic is follow the money / 6 layers of investor protection. So in today's episode, we'll dive into follow the money strategy, a powerful approach that helps investors spot where the best opportunities are following in the real estate market. And we'll also break down the 6 essential layers of protection every investor should use to prevent capital loss and safeguard their investments. So, Brenda, let's start with this first question. Can you explain what follow the money strategy is and how it applies to real estate investing?
Yeah, absolutely. So it's pretty straightforward. It's exactly what it sounds like. You want to follow the money. Wherever the money's going is where you want to be, essentially. And a good way to put this is money just doesn't disappear, right? When you get these economic contractions, the stock market goes down, bond market goes up. That's just money moving to different areas. A funny play that I like to say is you want to be in the toilet paper industry when COVID hits, right? Because COVID shut down a lot of industries. Tourism didn't do really well. The hospitality industry, the restaurant industry, they got hit hard. But man, Zoom stock and toilet papers, right? Like that was where you wanted to be. So that's the kind of game here. So there's 4 different types of money. You've got institutional money. These are going to be like your big funds, capital partners, hedge funds. You've got large corporations. So these are like the Amazons, the Oracles, the Lance Bernsteins, the very large businesses. And you've got small businesses. When small businesses move to an area, they're going to bring people, they're going to bring jobs, and that's going to bring money. And then the last number 4 is the people, the consumers itself. So those are the 4 different types of revenue streams that you want to be chasing. And so the question becomes, well, how do you know whether or not those 4 types of capital are moving into a particular area or moving into a particular asset class? And the way to identify that is if you've got institutional money moving into an area, look at the cranes downtown, right? Nashville, Tennessee, let's say an example. Great market. It's got all four of these. Not the only spot in the world that's got it. There's some other markets that are fantastic for this, but how many cranes are being built? What's happening to the city's airport? Is it expanding? Grab a copy of the local business journal. It'll tell you how much institutional capital there has been coming into that market because it's pretty easy to track. Nashville, for example, I think it had $5 billion of institutional money come in from 2010 to 2018. And right now, between 2020 and today, it has over 7 billion. So that tells you there's a lot of institutional money. The number of hotels that are moving into a particular area, right? That's a great way to track how much money is moving into an area. You can see all the hotels that are slated for construction. And then, the next you got large corporations, right? This is pretty easy. How many businesses are moving to an area? Small corporations or small businesses, what is the leasing doing? Look at the commercial leasing prices, track it, go pull that data. If commercial leases are going up and there's not a great supply, that tells you that there's a lot of small businesses that are moving to that area. And then lastly, consumers, right? This is pretty easy. What are residential housing prices doing? What's the population growth of that city? These are very quick, easy metrics that you can pull online with a little bit of research that tells you if money is going to an area. And, we can kind of talk later about specific asset classes, but that's your breadcrumb trail.
Great. I love that answer. So let me ask you this question. Are there any specific markets or sectors where you see this strategy working particularly right now? I know you mentioned Nashville, but other than that, because a lot of times investors are not in the same area where they're investing.
Yeah, 100%. So Austin, Texas was a good one. If you look at Dallas, there's some cities down in Florida. A good indication of where to start looking right now. COVID revealed this environment that we all knew was there, but it just made it very apparent, which is you've got business-friendly states and you've got non-business friendly states, right? COVID made it very apparent which states were highly regulated. They shut all the businesses down. And this caused a lot of pain. And so a great area to start looking is what states are more business friendly, because that's the heart of these four revenue streams, right? I said institutions, I said large corporations, small businesses, and consumers. The heart of all those is where are the businesses going and what is driving that growth? And a big part of it was COVID. States like Florida, Tennessee, Texas, they didn't shut everything down during COVID. They're very business friendly states. They're very pro business. And so that's a great place to start looking is those particular areas. You can go pull a top 10 fastest growing cities in the United States report. I think Nashville's been on there for like 6-7 years. I think Austin's been on there, and you can see where people are moving to, where are consumers going. And again, because wherever the people are going, wherever the businesses are going, that's where the money is going.
That's a good one. You said business-friendly states or finding the business-friendly states. So question comes to my mind. If I'm a passive investor, why should I pay attention to this strategy? And how would it help me identify the best opportunities?
Yeah, that's a great question. So there's a lot of different ways we can kind of tackle this, but you're in the multifamily world, right?
Okay.
When I tell people who are building self-storage units or they're building multifamily or they're in the commercial world, right? Commercial is a broad spectrum because you're renting to specific businesses. You're in whatever business your tenant is in.
Mhm.
That is the business that you're in. And
Mhm.
so how successful that business is how successful you are. And so you want to make sure that your tenant or your customer, whoever you're servicing, like we build a lot of entry level single family homes. Our customer are first time home buyers or very large builders like DR Horton and Lennar, where we develop and sell the land to them. And so you want to make sure that the environment your customer is in is successful. And so one of the biggest indicators of whether or not your client is going to be successful, which
Mhm.
influences your success, is how easy is it for them to do business in a particular area, right? Is there a lot of obstacles that the government puts in their way to get deals done? Do they have landlord rent controls? Or
Mhm.
does it take a year to evict your tenants if they are not paying you, right? Because that bank's still got to get paid every single month. And so looking at what the environment is for your particular customers and making sure that it's successful, that's a huge part of it. And a big part of that is how business friendly is your local municipalities. Nashville, Tennessee, for example, the reason we have so many large corporations specifically moving here, like Amazon just built a 5,000 person C-suite skyscraper downtown. Facebook set up like a data center here. You had Oracle and Alliance Bernstein move here, is because the city was giving them incentives to move their businesses here. Basically, cutting their local taxes, right? Giving them tax breaks. And so that is a great indication that, hey, we want to do business friendly. We want to make it easy for you to be here and do business.
Wow, I like that. And then you said one very good thing, the client success is your success because you are not just investing, whether you're doing a single family, land deal, multifamily, self-storage, whatever you're doing is by the end of the day, your client is either your tenants or your investors. You're creating that experience for them, that particular experience they're looking for. And that's very, very important. A lot of time people forget that. It's not about money all the time. Yes, we're talking about follow the money, no doubt about that. But at the same time, creating that particular experience for that client, for that customer. So making sure that they feel happy or they're getting the experience, whatever they're looking for. And that's a win-win for both of us, whether you're investor syndicator or the acquisition side, whatever you're trying to do as holistically, it's kind of happy kind of environment. So let me ask you this question. How has following the money personally impacted your investment decisions and your successes? I know you were in the medical devices sales before, so let's talk about that a little bit.
Yeah. So, man, where do I start? They say that a high tide lifts all boats, right? And so there's some really great wisdom that I cannot take credit for. Warren Buffett has this quote that talks about when the tide goes out, you can see who's swimming naked.
Mm-hmm.
And, for me, I got kind of lucky, right?
Mm-hmm.
I didn't know all this beforehand. I was in the Nashville, Tennessee market for 10 years ago. I moved here 10 years ago. It was for healthcare, for medical device sales at the time. And I wasn't in real estate. I didn't have this passion to go and be an entrepreneur. I was actually fired from my job one lucky Friday. And that's how I started my entrepreneur journey. And so I was blessed to be in one of these markets. Like I said, Nashville, Tennessee, it's been one of the top 10 fastest growing cities. There's been tons of businesses that are moving here. There's over $7 billion of institutional capital that has planted its roots here, and that's continuing to grow. And so I was kind of right place, right time when I stopped my whole corporate career and began this entrepreneur journey. And so that played into my success. Again, when I was starting out, I didn't have to be based on where the market was. I didn't have to be super amazing, awesome business person because real estate was just going up at such a rapid rate at the time. I had some successes or some skill sets that I took from medical device sales, which was my sales experience. And I was able to luckily apply that to real estate. I went from business to business experience, which is going after doctors and surgeons and hospitals and these very complex purchases and sales to get my products to be used to, hey, I'm showing up and I'm dealing with everyday average Joes that have land and want to build rapport with me and see me, and I can easily get access to them. And so I came with this very sophisticated set of skills involving sales, and I was able to apply that to the real estate industry. And that's what really allowed me to be successful because I was also in the right place at the right time. The high tide lifts all boats. I was not the best real estate investor when I first started out. In fact, I lost $40,000 on my first new build. That $40,000 was better spent than all of the money that I had poured into my college degree because it taught me real world experience. Thank God I didn't go and get an MBA, a master's in business, because that $40,000 taught me everything I needed to know about how to try to run a successful business.
Oh, so talk to me or tell me about this transition was intentional from medical device to real estate. How did this transition happen exactly? And what is the story of the $40,000?
Yeah. Well, the short story is when I first got into real estate, I did not have this story where I was, always dreamed to be an entrepreneur and I was sick and
Mhm.
tired of the corporate career. You hear that a lot. Uh, when I was in my early 20s, when you're a young buck and you're starting your corporate career, all you want to do is make your family proud. So I did exactly what society told me to do, what my parents wanted me to do. I got a nice, safe corporate job with
Mhm.
a company car, a 401k benefit. I mean, I had it all. I mean, my rent was like 1/10 of what my income was. I was making really great money. I was stashing money away in all my retirement accounts. And I did what I wanted, what everybody else wanted. I thought, okay, if I do this, then I can become financially free eventually. I can do what I want with who I want. I've got the flexibility. And so the big wake up call for me came when I was sitting down one sunny Friday afternoon around 4 p.m. at the Starbucks over in Weston in Nashville, Tennessee. And my boss sits me down. I was having a fantastic day, had a successful surgery, had a capital equipment trial that's like saws and drills and really expensive medical equipment. Like I'm talking, 60, 70, $80,000 worth of stuff that was going through. That's a big sell for 1 month for one transaction. And before I could tell my boss how excited I was about this day, he fires me.
Whoa.
I remember sitting there, my jaw hit the floor and I was silent. I mean, I was dead silent. And then his words after that were, Brandon, I don't think you're a fit for us any longer. And I hope that you learn something from this. And after the shock for 3, 4 hours and calling my family. I mean, I was in shock. Like I had all these fancy sales awards. I lived, breathed, and eat my job. I loved it. My boss was somebody that I looked up to. And, as you know, a lot of people, a lot of young guys, especially their boss is kind of their mentor early on in life. And so I looked up to this guy and like I felt like I was being abandoned. Seriously. Like I was like, oh my God, I look up to this guy and here he is kind of cutting me loose. And that day I learned something. I learned that nobody was going to look out for my financial well being but me. You can be as loyal as you want to these companies. You can put in all the blood, sweat, and tears. You can spend 10, 20, 30 years climbing this ladder, all to have it disappear in an instant. So I learned that nobody was going to look out for my financial well being but me. And so it started this entrepreneur journey where I started a course on how to break into medical device sales. That failed. I started a online life coaching business. Funny,
Mhm.
nobody wants to take life coaching advice from a 25-year-old. So that failed. I started a online motivational blog. I thought I wanted to be the next Tony Robbins. That failed. And then I discovered real estate. And man, at first, Mickey, let me tell you, I felt like a fraud when people asked me, "Hey, Brandon, what do you do for a living?" And I say, "Oh, I own my own business. I'm a real estate entrepreneur." But like total fraud. When I was hiring people, I did not know what I was doing. I was so scared of what they would think of me. Like, who's this idiot that is hiring me? I'm not going to go work for him. Can he even afford to pay me? I had one person I was interviewing actually ask me, "Was the business successful?" And I'm like, Eh, not really. But I'm getting it on its feet. And so there was a lot of failures along the way. I lost $40,000 on the new build, and I can tell you that story here in a second. But I did over 187 transactions, and something magical happened. I started to get the hang of it. I started investing in myself. I started investing in mentorships, coaching programs. And Lord and behold, I learned how to build a team around me. I learned that I can't do all the jobs that are associated with this. And so now I'm blessed to say that real estate has unlocked a lot of freedom for me. I get to travel 6 weeks a year, and I've got a couple things that really define my success. How much money I make no longer defines my success. I do these trips every year. I do an annual mom son trip. My mom was a history teacher. She's kind of retired now, but we go somewhere historic, somewhere that she never had been able to afford before, but she had taught for 25 years in the history books. Like we're going to go to San Antonio here in a
All
few
right.
weeks and do the Alamo. I've been able to take her all over the country and everything is history themed. I do an annual brother sister trip. No matter how busy they are with the kids or everything, we make 1 week in a year and we go travel somewhere on their bucket list. Take my dad to go through things that he would never be able to afford to do on his own or want to do. Like he's a big bourbon guy. We did the Kentucky Bourbon Trail last year. This year we're going to go to Moab and we're going to go drive Broncos around because he got the new Bronco over the rocks and all that kind of stuff. And so I'm really proud to say that I've been able to build this life that's allowed me to do the freedoms to do what I want with who I want. And I tell you this because I don't want you spending 20 or 30 years climbing some corporate ladder without a plan and watch it all just disappear in an instant. Make a plan to make money yourself while you sleep, because you never know when your corporate job's going to disappear. And so that's that. I can tell you the new build story if you want, but
Oh, that's really good. I really like that. And you said one thing very well. A success is not about the money accumulation, it's about the freedom. The freedom that you get, the time freedom, the location freedom, you get to travel, you have the time on your hands, you can use it the way you want to use it. The quality time with your loved one, with your mom, dad, your family, that's the most important thing, you know. That's what call is success, you know. Because as long as you're feeling successful, you're feeling happy, you're feeling contented, that's what matters. It's not all the money that you're accumulating. I think that's just a gimmick out there in the material world that we think that if we have $20 million, $100 million, then we'll be happy. And we wait for that happiness. And guess what? When the $100 million accumulated, it might be your last breath. You're gone. Poof. You never got to enjoy. You never got to be happy all your life. So this is a really good story. I really love that. So let's come back to follow the money. You know, I really love that follow the money concept here. So how do you adapt to follow the money strategy in different economic cycles, like during the market boom versus downturn, like kind of the market that we are in? So much uncertainty. Everybody's sitting on the sidelines, whether they're savvy investors or when they're maybe they're beginners, you know, whether they're institutional funds or family office, whatever. Everybody's waiting. I think there's gonna be rock bottom. That might not happen. That might already happen. Who knows, right? It's very hard to time the market that way. So I wanted to hear your thoughts on that or your experience on that.
yeah, so it's paying attention, right? Because money changes direction. So let's just kind of play with this for a second right now. Interest rates are being watched because interest rates have a big impact on where money is going to flow to. So let's just say that, rates come down significantly. I was looking at the federal funds tracker and it looks like 38% of the market believes that in 2025 you're going to see like 3% interest rates. I was looking at this and I was like, wow, that's pretty low. When you have rates come down that low, all of a sudden people are going to probably start selling off their bonds because they've made a lot of money on them and they're not going to get the returns buying new bonds. And that's probably going to flow to equities. That's going to go in the stocks, which are companies. And so you're going to see some revitalization there. You're going to see a ton of bent up demand, especially in the housing market, rush into the market. I promise you this, because that's what we do. We do a lot of entry level housing. So first time home buyer housing. We know that 33% of the home buying population, millennials specifically, are at prime home buying age, and there's less than 10% of affordable homes being built. I don't need to be a genius to tell you that there's a huge supply and demand imbalance right now. So for the last 2 years, there's so much pent up demand in the housing market. First, it was you can't find a home because there's 20 offers. They sell in a week. There was buyer fatigue. They were sick and tired of visiting 20 homes and not getting one. And so they said, let's just wait and let it cool off. Rates went up. Now it's too expensive. So you have so many people that are waiting to buy a home when they have an opportunity to do so. And that opportunity, Vinki, that is coming. You're going to see a lot of capital move into that space, specifically, I think, entry level housing. And that's what we're poised for when that happens. When you have rates come down, that's going to free up a lot of consumer spending. It's going to be a lot more affordable to borrow money and go and start spending things when things are scary, when there's a lot of hesitation in the market, when things are volatile, when there's an election, people aren't sure who it's going to be or what the policies are going to be in the future. Rates haven't come down. Money sits on the sidelines. It sits in savings. You don't have as much money circulating in the economy because it's sitting in bank accounts. That's where it is. When rates come down, it becomes, and you have, we have a really big election coming up. I think there's a lot of people that are sitting on the sidelines that are waiting to see what happens there. And once a presidential candidate has been selected, they will know or have an idea of what direction the economy may go because of their policies. And you're going to see that capital come back into the sidelines. And so as things change, the areas that capital flows into will adjust as well. And so we're looking for supply and demand imbalances. And so right now, It's no secret that we're short anywhere between 3 and 6 million homes, depending on which news article that you watch. You've got over 60% of homes that have a mortgage rate under 5%. Like they're not going anywhere. And so we know that there is a lot of demand and very little supply for entry level housing. And
Mhm.
so the follow the money, we know that money is going to be pouring into that asset class and we're positioning for it. So those are some examples of kind of how we're adjusting our follow the money strategy and how we're using it.
That's good. And everybody needs a place to live, anyways, by the end of the day. But I have one question for you. You might have heard this, in the newer generation, in the current era that we are in, most of the younger generation is all about experience. Is I will call it Gen Z or whatever the new generation is. They are more like an experiential generation. They don't believe in buying, holding, hoarding. That's the reason so many companies are out in the market. Like for example, this Uber or what other companies, where the sharing companies, Airbnb, all these are sharing companies, right? Because they are not into like more like buying. So what do you see in your crystal ball from the single home concept that you guys are developing, trying to create your business model? Your business model is based on that. What do you see in your crystal ball is going to happen in the next few years?
So we're looking at facts and data and not necessarily perception. I agree with you that the younger generation, and I'm part of that younger generation. Like I'm
Mm-hmm,
34 years old and I don't like to be tied down by things. I did until my first kiddo was on the way. Right.
mm-hmm,
And so I'm looking at where the needs are. No matter what the younger generation thinks of crypto or real estate or traveling or just buying a home in general, certain things are not going away. You're going to need somewhere to live no matter what. And so you're going to have more homes despite whatever's going to happen. Like there's no getting around that, right? People aren't just going to stop purchasing homes. That's just not a thing, right? People are always going to have somewhere to live. And so we're looking at the data, and the data is telling us that we're 3 to 6 million homes short. The markets that need it the most are the fastest growing markets where all of the follow the money, the institutions, the large corporations, the small businesses, and the consumers are being there. And the asset class that we feel like is the most highest demand, least supplied right now, is that affordable entry level housing product. And so we're looking at data more so than just what the young's perception or what the youth's perception of a particular asset class is.
hmm. Interesting. Okay, so let's move on to the topic number two, the 6 layers of protection. We talk about follow the money. So let's talk about 6 layers of protection. What are the 6 layers of protections investors should incorporate into safeguarding their capital loss or gain?
Yeah, so we can. What I'll do is I'll name all six, and then if you want to go into some like stories or some real world examples, like how we're utilizing each one, we can do that. But number one, surprise, surprise, multiple exit strategies. But this one's easier said than done. A lot of asset classes, there's like one exit strategy pushed in there, and we don't. We want 3 to 4 different exit strategies that are
Mhm,
guaranteed or near guaranteed. The
mhm,
second is the ability to control the debt. There's $2
mhm,
trillion of bridge debt that are coming due, right? It's happening. We've seen the famous foreclosures in the downtown San Francisco area, a lot of large portfolios in the southern Texas market. It's all because they did not control the debt.
mhm,
Their bank notes came due. So you want to try to eliminate that risk. Third is the ability to hold. So how long can you continue to hold this asset to go through every single up and down that the market can throw at it? The
mhm,
fourth is you want to have the ability to force appreciate the asset. That's what I love about your asset multifamily is you
mhm,
guys are able to buy it, renovate it, increase the rents, and force appreciate that asset.
mhm,
The fifth is having your exit lined up. And so we want to make sure that we have our exit lined up. If we can eliminate having to put an asset on the market and hope that it sells and remove that time risk, that market risk, that speculation, that's what we want to do. And so that's the fifth. And the sixth is you want a lot of downside protection being built in. I think the reason you see a lot of distress in the commercial world and multifamily world is people were not building in downside protection. They were not factoring into their underwriting a reduction in rents or a reduction in their NOI. And so they're feeling it right now. So those are the six, and happy to go into those further if you'd like.
So let's start with the last one, number six, downside protection, because I'm in the multifamily space, and we try to, look at holistically how the deal should perform, come from conception to completion, and to make sure we have enough reserves for all the downside, I would say, that you can call it the downside protection. And then we feel like if it needed, we might be able to hold the asset for a little bit longer too. But I just wanted to hear from your angle, what specific things that you look at it and how would you describe the downside protection?
Yeah, so this is really, really easy. One of the questions, like when we do discovery calls with new potential investors, a lot of them will ask this question. I love this question. I always ask, what is something that I should ask you that I have not asked you? And I love it because it's a brilliant question. I tell them before investing your money in anything, I don't really care what it is, how far does the asset's value have to fall before you break even? What does that look like? If it's a multifamily investment, like what does the interest rate on your loan have to go to? What does the vacancy have to go to, right? What does the reduction in net operating income have to go to before you break even? Very few people ask that question and know that. And so, for example, right now, we're developing 74 lots for a very large home builder in the Nashville, Tennessee market. All those lots are pre-sold, right? They've put down $500,000 of earnest money. It's been released. Like they've got a lot of skin in the game. We're selling those for about $86,000 per lot. Our all-in cost with acquisition is $61,000 a lot. And so it's very simple. You'd have to see the value of each one of those lots go from 80, 85, 86 down to 61. And so that's roughly a 25% reduction in value before you break even. And so that's what we want to see. I like deals like that. And again, we own the land outright, right? We've got investor partners. There's no note that can get called due on us. We own this outright. And so we have the ability to hang on to that and kind of stomach anything. But that's the downside that we're looking for there. If you can't stomach a 20, 25% reduction in value, and you don't have the ability to hold for the value to come back up over time, that's when you get into trouble.
That's good. So I like actually this six layers. So I'm just thinking out loud here. When I'm thinking about these six layers, can you explain how proper deal structuring fit into the six-layer protection? And how can it prevent the capital loss or gain? Let's talk about both sides.
Yeah. So we're number one, you've got multiple exit strategies, right? For us,
Yeah.
everything we do starts with the land. Every piece of real estate, commercial, multifamily, residential, whatever it is, it starts with the land underneath it. And what I love about this strategy and what we do is it's different than everything out there. When you go and you buy a multifamily property, or you go and you flip a house, or you're, let's say, building something, all the equity and profit is created on the back end. It's after you purchase the asset and you execute the value add strategy. What we do is we partner with the local municipalities, the planning commission in the city. We identify the vision for the community, and we pull up a chair on the same side and say, what is lacking? What do the citizens want? What do you guys want? What's the vision here? And we go and we help make that a reality by putting land that is not the highest and best use under contract. And we force appreciate the value of that land through a rezone process. Basically, we turn it from farmland into beautiful entry-level housing communities. And after we get our approval in place and the appreciation has happened, the strategy has happened, that's when we buy it. So we buy it after we have forced appreciated everything. We've created all of this equity. And so that's very key, because what happens after that is one of three things. We've got multiple exit strategies here. Number one, if there's a ton of development in an area, we can just land bank it with our investor partners. We can buy it outright, sit on it. We all have equity in the deal. There's no bank note, and we hang on to it for a year or two and then sell it. Because when you've got the first equity boost is when we do the rezone and we add all the density. The second equity boost happens when all the development around it is completed, and you've got a parcel of land that's kind of like an island sitting around a bunch of development. It's worth a lot more. So that's exit strategy number one, is just buy and hold the land and sell it. The second is we can actually go and develop it and sell the finished parcels to commercial builders, to residential builders. Our bread and butter right now are national home builders. So these are like the Lennars and the DR Hortons of the world. So they'll say, hey, I'll buy these finished pads from you for $86,000 a pad. We look at what our costs are to develop. And if it makes sense, we will develop and we will sell those lots to our builder partners. And so it's nice because they're all pre-sold with very large earnest money deposits. That's exit strategy number two. The third is we can actually go and build the homes if we want to on it. So if we get stuck and can't find it, we can actually go in. We're a licensed and bonded general contractor. We do all of our own self-development. And so we're able to go in and actually build the homes and sell the homes. And then the fourth, we're trying to get the pencil. I have not been able to get any deals pencil, but build to rent. We want to be able to hold these long term. We've sold some stuff to some build to rent funds. And we're like, man, it would have been nice to keep all those townhomes. You know, we want to become like the build to rent fund. But those are some ways that we're utilizing the multiple exit strategies.
Mhm. Wow, that's good. So let me ask you this question. Which of these layers do you think is most overlooked by the investors and why?
I think that everybody is very familiar with the forced asset appreciation. That's kind of
Mhm.
like a no-brainer. I think that the downside protection, that's probably the most overlooked in my opinion. Because if you were to ask a lot of your investors or other investors, hey, what does the value of the asset have to drop down to? Or, you know, some of the terms that we talked about earlier, they can't tell you. They don't know. And so when it talks to, like, when we were building a bunch of houses, I'd tell all the investors, hey, you would see the value of the home go from, you know, $370,000 down to 300. That's your break even point there. And it was very easy to understand that because we're able to show them where they're at in the capital stack. And so not a lot of investors understand the downside protection. They don't realize that, hey, that bank's got to get paid off first. And if the sell price of the asset doesn't cover the bank loan, you're wiped out. And so there's been a lot of investors who've been very surprised with 100% capital losses because they didn't understand the downside protection piece. I think that it's number six.
Yeah, I can agree on that, but we do provide our investors with the sensitivity analysis, all the break even and everything in all our decks whenever we bring the deals to them, just because of that reason. So nothing
Yeah.
is being overlooked. I mean, this is a really, really good point, and it should be part of the due diligence process for each and every investor because it's very important for them to know the holistic story. And then they have to have that comfort level when they're going into any investment. Thanks for sharing that. We are really out of time. I can keep on talking to you. I mean, such a good topic, and I have tons more questions. But since we're out of time, I'm going to ask you one golden nugget at this time for my audience.
Give the audience one golden nugget.
Mhm.
You know, I would figure out what your unique ability is in life and try to get everything else off your plate. When I read that book's 10x is easier than 2x, and I realized, oh my gosh, like, what is it that you're passionate about? What is it that puts you in that state of flow that you
Mhm.
do that makes you the highest dollar per hour? And it didn't have to be, you know, like real estate. You know, you might have your current job and it's a particular activity or task that you do with your current job. Try to focus on that unique ability, because if you do that, I feel like you will be wildly successful and have an enjoyable life.
Thank you so much. I think that's a really good golden nugget. I really appreciate that. So this brings us to our vibe rapid fire round. I'm going to ask you 5 questions. You're going to answer it in one sentence or one word only. Are you ready?
I'm ready.
So the first question is, what is one of the most important things that you have learned in your life? How did your life change after learning it?
Yeah, so we just talked about one of those, right? Which is discovering your unique ability. So I'll
Mhm.
go through the second one, and this is pretty powerful and, you know, very popular, but it's the who not how concept, right? When I was building that first house, wore all the hats, completely miserable, couldn't go on. It wasn't until I discovered, hey, look, don't try to figure out how to do something, figure out who can I find to do it.
That's true. That's a really good one. That's the delegation comes in at that point. So share one good book with my audience that you like, and then you think everybody should read it.
Oh, you got to Robert Curry, also known as Bob Curry's book, The Turnaround. awesome book, firsthand experience, what it's like to turning around a failing business and what he did. You feel like you're right next to him the whole time. Awesome book.
In one word, what does life mean to you?
Energy.
I like that. That's a really good answer. What is your biggest passion?
Creating unique experiences with those that I love that they will never forget.
Oh my God, I really love your mindset being so young. Oh my God. If you could turn back in time and talk to your younger self, which will be like 5 years old, maybe you're so young, what would you tell yourself and why?
Oh, I could write a book on that one. God, there's so much that I wish I could go back and tell myself. Um, we talked about don't figure everything out yourself. That's a really, really big one. Probably don't sell all of your retirement accounts to fund your business. I don't know. That was I learned a lot from that, but start learning how to do partnerships sooner instead of doing everything yourself.
Yeah, I think that's a good one too, because you can alone you can go only so far. But when you're collaborating, you are moving much faster. So this brings us to the end of our episode. How can people reach out to you?
Yeah, if you're somebody who's interested in, diversifying into entry level housing, if you want to learn more about building a legacy, reaching financial freedom, and, ultimately trying to make an impact and retire, you can go to our website, hbgcapital.net. It's pronounced Harry Bob Gary capital.net. I joked that .com was taken already, so it is .net. But on that website, we have a free ebook, 100 questions business owners ask before investing. And it's a free book. You can grab it. I wrote that book because one of our investors reached out one day, asked if I could help his friend out who lost all of his money on a real estate investment with somebody that he trusted. And it became very evident on that phone call very early on that he was very green and he just didn't know how to properly secure his investment, do any due diligence on the operator, do any due diligence on the deal itself. He did not know what questions to ask. Questions unlock Questions are the keys that unlock the answers we need to make more informed investment decisions. And so, had he been armed with the right questions, I'm convinced he would not have lost money on that investment. So, in hopes that I could prevent that scenario from happening to somebody else, I wrote that book. So, you can go to our website, grab it, hbgcapital.net. We've also got a podcast where we interview entrepreneurs. We talk about real estate and investing. You can check us out on that. It's called the Recession Resistant Real Estate Radio.
All right, thanks. And I really enjoyed our conversation today. I'll look forward to having you back some other day. Thanks.
Okay. Thank you so much.